You're listening to the Jewish Entrepreneur Podcast with Debbie Sasson, episode number 180. Welcome to the Jewish Entrepreneur Podcast. I'm your host, Debbie Sasson. I went from being a financial advisor, author, and chronic under-earner to building my business to six figures as a financial planner and money mindset coach, and then onto multiple six figures as a full-time money and business coach. I help entrepreneurs create money-making businesses and build wealth using sales and money mindset strategies and in alignment with authentic Jewish values. Now, let's dive in to today's show. Hello, my friends, and welcome back to the podcast. Before I share with you who our guest is going to be on the podcast today, I want to let you know that for the last week, I have been celebrating my birthday. My Gregorian birthday, English birthday is July 24th, and my Hebrew birthday is the 3rd of the month of Av, which, as I'm recording this podcast, was yesterday. And every day for 6 days, I shared with my newsletter subscribers and those people who follow me on social media different offers. And if you are not on my newsletter or you're not following me on socials, my question for you is why not? I've been sharing really amazing offers, and the most important one, I mean, you can get them all. You can find me, follow me, and find out about them. And some of them have prices that were special during my birthday, and some of them still have prices that you can get because I was giving beautiful birthday discounts. But I want to let you know about a masterclass that I'm going to be running at the end of August called Charisma to Cash. Because what I find is that so many people are like stuck in their heads when it comes to writing content, whether it's an email, recording a podcast, putting something up on social media, whether you're on LinkedIn or Facebook or Instagram, I don't know, wherever else, TikTok, or maybe if it's even writing a workshop that you're going to give live or a webinar. We get so stuck in our head and we spin around and around and around. It takes way more time than it needs to. And your magnetism, your charisma isn't shining through. You're in your head, or you go to ChatGPT and you sound like a robot. And hey, I like AI. It has helped me do a lot of things and make my business more efficient. But I want your content to sound like you. I want you to show up with charisma and flair like you know how to do when you work with your clients. So I'm running a workshop, Charisma to Cash, at the end of August. I had it on special for my birthday for $62. It's now gone up to $162. But if you send me an email, tell me that you heard about it on the podcast, share the word charisma, I will issue for you a special coupon so you can get it at the birthday price. All right, so that is my special gift to you, my podcast listeners. Now, let me share with you a little bit about our guest today, Adiel Gorel. He is a tech veteran. He grew up in Israel, went to school in Israel, and learned all about tech way before his time. I mean, now we all know what's going on with tech in Israel, but Adiel left the Holy Land. We can talk about that another time. And he went to the Silicon Valley to really make his way in the world. We talk about this on the podcast. And then he left his high-paying Silicon Valley job to focus exclusively on real estate investing. And here's what makes this story so compelling, so incredible, really. Adiel bought 22 homes in just 1 year. And that was also while he was working full time. He didn't have a gazillion dollars in the bank, but he learned how to invest in single family homes, in real estate in the United States. And since he started doing this, he has helped tens of thousands of people do the same, including over 2,000 Israelis. And Adiel is showing people how they can use real estate to build wealth and also just build out your retirement. So if you've ever thought about investing in real estate, I do have personally one investment property here in Israel. But if you've thought that real estate is too complicated, it's too risky, or it requires a lot of money to get started, You are going to love this conversation. We're going to open your eyes to actually see what's possible with real estate investing. And Adiel breaks down exactly how he did it, how you can do it too. And I challenge him on the podcast also because there are risks involved and you want to make sure that you are aware of the risks. And I challenge them and I think you should take those to heart because we maybe didn't go into those deeply enough. But without further ado, let me introduce you to Adiel Gorel. Hello, Adiel. I am so happy to have you on the podcast, and I know this is going to be a juicy episode for all of our listeners.
It's a pleasure to be here, Debbie. Thank you.
I want to introduce you to my audience, and your audience probably knows you a little bit already, but you are, I don't know, you're almost like a Renaissance man. Right, you and I talked a little bit before we got on the show. You did the normal, good student thing, you were born in Israel. We'll talk about that a little bit. Now you've lived in California. I, of course, was born in California, now live in Israel. So you and I crossed over airspace somewhere, which is kind of funny considering that the skies over Israel are closed today as we record this, but never mind. Then after you did your army service, you went 5 years traveling around the world. You told your parents, this is it. This is my time. And I love that. By the way, I did the normal thing of going to work on Wall Street after college. And then I told my parents after 3 years, now I'm going to Israel. And I just never left. So, I had gone from LA, New York, London, and then I ended up in Israel. So I didn't quite do the trip.
You keep going east.
More or less. Exactly.
But don't continue. You can stop there. You don't have to go more.
I don't know. We're going to see how far our army advances and how much of the East we're able to take over. But that's a topic for a different conversation. So
your proxies are going east.
Yeah. Exactly. But then you studied. You have 2 degrees. You completed a PhD?
I started a PhD and I decided I thought a PhD should be a labor of love.
Uh-huh.
And I didn't feel like I was in love with my field. So actually, technically, I'm still on hold at Stanford to come back. But of course, I mean, that was decades ago. I'm not coming back. But I thought it should be something that you're really, really passionate about. And I wasn't.
Right. My husband was actually going to do a PhD in Israel. He's a scientist. And when he went, he's not good with languages. I can speak Hebrew. After 38 years in Israel, he still speaks like he's an Oleh Hadash, like a new immigrant. Just, your English is very good. You guys would speak definitely in English. But he was told that the guy who was interviewing him told him, you don't want a PhD, you want a job. He's like, yeah, that's right. So he ended up getting a job and not exactly in his field because the science areas in Israel are so much smaller than they are in the greater world. But then you went into high tech and then you went into real estate investing and you've had so many different iterations and evolutions over your lifetime. And I just love that, like really just following your inner compass and figuring out what you want to do with your life. So how did you decide on tech?
Okay. I mean, as a boy growing up in Israel, especially when I was a boy, the bias was very strong. If you were good in math and physics, you're going to be an engineer because that's where you get a good job. That's my family traditional. They put it into my head. And I too, I remember even sitting with my family. It's so funny looking at the weekend paper in Tel Aviv when I was younger, and I was looking at a jobs section. I was just a teenage boy, and it was all, electronic engineers, electrical engineer. I said, that's what I'm going to study because this is where the jobs are. Plus, the excitement of learning all the new tech and stuff like this. So I knew I was going to study engineering.
Okay. And I don't think that's changed a lot in Israel. I mean, we are still on the forefront of engineering and science and technology. And, you're in the Silicon Valley or near the Silicon Valley. And here we are, Startup Nation. We're Silicon Valley #2. And because of our security situation, it is still very much who we are as a nation. And that's where the really high salary jobs are. And all of our startups that sell out, to Google and et cetera, et cetera.
Yes, absolutely.
So how long did you stay in tech? Because we're going to talk about investing. And I think that's so important for my listeners to understand the importance of investing and getting started as early as possible so your money has time to grow. When did you realize there was something else available, something else in life that you could put your heart and soul into besides just tech?
Okay, so I was doing my graduate studies. I was living, in Palo Alto, California,
Mhm.
right in Silicon Valley, going to the university there, doing my grad studies. They wanted me to teach some courses, and I taught at the university. I really like teaching, and it was great to teach smart students. It was really a joy. And then I got my first job in Silicon Valley. Now, that was in the 1980s. In
Okay.
the 1980s, we didn't have Google, we didn't have Amazon, no Meta, no web.
No
So,
internet.
well, no web. There was the ARPANET at Stanford, which was the precursor to the internet. So, I mean, the company I really wanted to work for at the time, because all of these biggies did not exist at all,
Right.
was Hewlett Packard Labs in Palo Alto. It was considered to be a great research place. And if I got a job there, I could continue to do my research at Stanford and at HP Labs. I did get a job there, fortunately. And then it all started. So here I am, a very young guy.
Mhm.
HP paid me so much more than Stanford. So I'm
Right.
thinking, whoa, I'm getting paid so much because my expenses were very low. I was a single young guy, expenses very low. All of a sudden, I'm hit with this big salary, very much like today when a young person gets a job at Google, they say, oh, that's a nice kind of thing. Okay, so that was one thing. The
Oh, wait,
second thing,
I want to stop you right here before you gonna get on to the second thing, because you grew up in Israel, in Tel Aviv, it sounds like, but the lifestyle, the standard of living, certainly more than 40 years ago, 50 years ago. I mean, I've been here for 37 years, and the standard of living today is significantly different from I visited here the first time in 1984. And when you say your expenses as a single guy were low, but as an Israeli, were your expenses even lower because your lifestyle was just different, or it didn't make such a difference?
at the time I got my first job at HP Labs, I had already spent a lot of time in North America, so I don't think so. I mean,
Okay.
they were just low because I was never a big spendthrift and I didn't need much. And
Mhm.
my even though I was living in Palo Alto, which is not a cheap place to live, expenses were low. So the salary was very high. So I was a young guy hit with a high salary, and then in my research lab at HP, I was the youngest guy, but there were people there in their 50s and 60s as well. Brilliant.
Okay. Yeah.
And so immediately I logically thought if they have been working here for 35 years and getting paid like this, they must be very wealthy. That
Mhm.
was a logical assumption. Once I got to know my colleagues, I quickly realized that was not the case at all. They owned their own home and a 401k. That was it. So right away, I said, there is no way I'm going to work here for 30 or 40 years and look like this financially. Now, when I grew up, my family was in the real estate development business in Tel Aviv on a pretty large scale. Now, as a little boy, all I wanted to do was play. I didn't care about what my family did.
Okay.
But you can't not be exposed to the talk, to the banter, to the why didn't we buy those? Why did we say? So, I mean, I carry this significant database in my system. And
Mhm.
I said, okay, it's very clear to me. Clearly, working and making a high salary in Silicon Valley is not going to cut it.
Okay.
Uh, my salary is good. My credit is good. I'm going to start buying rental homes and build, an empire
Mhm.
for myself so that when I get to 50 or 60, I will look completely different than what I see in my colleagues. And I went about it and I started. So back in the 1980s, there was an unwritten rule which said only buy rentals within 30 minutes drive of where you live. That's what everyone was doing. So that's what I was doing. I was a good boy. So I was living in Palo Alto, buying in Sunnyvale, in San Jose, Silicon Valley.
Right.
After a few rental properties, I discovered that I couldn't build an empire in Silicon Valley.
Mm.
Because even though the numbers in the 1980s were much lower than they are now, the ratios were pretty bad as well, just like they are now.
Well, tell our listeners when you say the ratios, you're talking the rent to value ratio. What are you referring to
Rent to
specifically?
value ratio, rent to value. So, it's so common. somebody has a house, in Menlo Park now. It's near Silicon Valley. And they say, oh my God, I'm renting it for $8,000 a month. And people say, what? That's the outrageous $8,000. How much is the house worth? $5 million. So the rent is unbelievably low relative to the. So back then it was the same.
Okay.
It was the same. The rents were too low. So clearly, when the rents are too low relative to the prices, you can't build an empire. So I had to do a little research. So as I already said, back then we didn't have the web, and Larry Page and Sergey Brin were in grade school. So we didn't have any searches okay, but I still was working at the lab at Stanford, and they had the ARPANET. The search function was very rudimentary, was just a line item thing. But with a little research, I discovered that if I flew an hour and a half from San Francisco, I would land in a smaller city by the name, let's see, Las Vegas was the name of that.
That's exactly what came up in my mind. Las Vegas. Okay.
And I discovered that I could buy homes in Vegas that cost 1/4 of the Silicon Valley price. But much to my surprise, the rents were very close to 1/2 of the Silicon Valley price. Now, that was infinitely better. I started flying to Vegas every week. Now, the people in Vegas had never seen anyone buying out of state at that time. Nobody. And I always looked younger than my age. Back then, I looked like a boy. So they were totally skeptical. They didn't want to work with me. I was just going to waste their time. So I went about doing what I knew had to be done, finding a local property management firm. Because obviously, if I live in Palo Alto, California, and I buy homes in Las Vegas, Nevada, I would need a local property management firm to handle everything.
Yes.
So I started to interview and talk to management companies. After a couple of months, I found a management company that I liked. I was still very nervous because I didn't have a chance to try them yet in the field. And then finally, a local broker took pity on me and said, I will find homes for you. And I started buying. Now, I was always very aggressive. So in my first year in Vegas, I bought 22 homes. Now,
wait, we have to talk about, are you using one property and taking a mortgage on one property to buy the second property?
I'll explain.
Okay, I love
it. Great minds. I'll explain exactly. So before your listeners, get impressed by that number, 22 homes in 1 year, let me share that the average home that I bought in the 1980s in Las Vegas cost, drum roll, $39,000 for the whole house. And not only that, Fannie Mae back then didn't have a 10 loan limit per person like they do now. They had no limit. And back then, even as an investor, I could buy a home with only 10% down payment with private mortgage insurance, which I did. Because even though I was paid well, I was young and my cash was limited. So I wanted to stretch my cash. Under these numbers, for somebody who's making a good salary in Silicon Valley, buying 22 homes, financially at least, is not hard.
Can I ask you how much you were making in the 1980s in the Silicon Valley?
To tell you the truth, I don't remember, but it was certainly under 100,000.
Okay.
I think in today's money, it would probably translate to maybe a couple of hundred. I don't know. It's hard. I don't remember exactly, but it certainly felt just like today, again, when my son is finishing engineering now. When he gets a job, it's going to feel like he's going to get that salary that lets a young person feel like, oh my God, I can buy whatever I want. I can do whatever I want. Yeah.
Yeah. I was just going to say, when I started working on Wall Street in 1985, so I remember my salary being over $3,000 a month. I don't remember exactly what the number was, but I remember in 1988, which was my last year on Wall Street before I moved to Israel, I was working at the time in London, so I was also getting a cost of living adjustment from New York to London. But in 1988, I made over $100,000 working on Wall Street, which again, for a single person is huge.
Oh yeah, in 1988,
it was huge. And now I'm wondering why I didn't start investing in real estate back then.
Yeah, I would say very quick math, like not really thinking deeply, maybe equivalent to 350 or 400,000 now, or maybe even more.
Right.
Yeah.
Nice.
It's very good.
Mm-hmm.
Okay, so I bought 22 homes. Now, during that first year, my colleagues in Silicon Valley were absolutely decimating me with, "You are insane. You're crazy. Nobody buys out of state. What are you doing? It's going to fail. You are an idiot." But after a year, when they saw me with more than 20 houses, the logic of the engineers started,
Mm-hmm.
deploying, so to speak. And they said, "Oh, you know what? We see what you're doing. We want to do it too." And I said, "You should. You absolutely should. It will change your future completely." And by the way, I told them, even if I did nothing else in my investment life ever again, besides the few homes in Silicon Valley and the 22 homes in Vegas, my future is already completely secure. Just if I stop right now. So you should do it. Go do it. And they said, "Come on. You work in Silicon Valley. You know how busy we all are. We barely have time to go to the bathrooms. You're already there with your managers and your homes. How about you lead us?"
Mm.
I said, "Okay, I will lead you." So I led a group of about 20 engineers. And over around 3.5 years, we bought about 250 homes. Now, we didn't buy them as a group. She bought 6 homes for herself. He bought 4 homes for himself. I bought a few more for myself. But I made a very trivial discovery. Even the very cautious engineer who bought just one little home as a test
Mm-hmm.
enjoyed the power, the cloud, so to speak, of 250 homes. Why? Because the service providers, most notably the property managers, knew if he wasn't happy with anything at all, he would complain to me. And now
Okay.
I'm not happy, and every other management company in Vegas is calling me all the time. "Come to us, move to us. We are cheaper, we are better, we are more reliable, we are taller, we are prettier." Who doesn't want to manage 250 homes, plus the many more we may buy in the future?
Right.
Then I started really enjoying it because not only was I changing my own future, I was helping my friends and colleagues change their future. And then, because it was so unusual to buy far from home,
Mm-hmm.
I started getting invited to give lectures all around Silicon Valley and San Francisco. In one of my lectures which I discovered I love to do, was really fun. So in one of my lectures in San Francisco, unbeknownst to me, was a reporter for the San Francisco paper.
Uh-huh.
Sunday paper, big article about me, my company, and all we are doing, led to an NBC morning news interview. I started feeling like, you know what? This is too much fun. I'm making a difference in people's lives. It's a lot of, I literally dumped my high-tech life.
Okay.
I formed our company, and in the 40 years, my investors bought more than 10,000 properties in about 30 markets, but the principle remains the same, except now we have markets where we bought 1,000 homes or 200 or 2,000. We even have one market where we bought 3,000 plus homes. And a couple of years into the game, I realized it's better to buy brand new homes. There's an article I wrote for an investment magazine, Why Brand New. I'll be happy to share it. I have several articles that I can share,
With pleasure.
including my TED Talk and everything. So brand new homes. But now when a new investor comes to me, let's say you, Debbie, you say, "Oh, you know what? This sounds so attractive. I'm living in Israel now, far away." By the way, out of the 10,000 homes, 2,000 plus came from people who live in Israel.
I
Because
love
I'm
it.
Israeli. In fact,
Yeah.
I have a branch in Israel. So, I mean, you can say, "Oh my God, maybe you can help me buy a home in market X." Of course, we have the infrastructure and everything. So you come in, and I recommend that people start with only one home. So you buy just one home.
Mm-hmm.
But in that market, we bought 1,500 homes. Well, you get the clout of 1,500 homes. The property managers are eager to please us with all this business, hence eager to please you. It doesn't solve all the problems in the universe, but buying brand new homes in good areas with property managers who got so much business from us is a great start for the busy professional to build a future.
I think this is mind blowing, and everybody should really just think about what they can do because they're busy, especially as women, but also men. We've got families, we've got kids, we have the job or the business we're building. And we talked about before, I just love putting my money into the stock market. It's really set and forget. I do have not even a 30-minute drive. I have a 5-minute walk from my current house in Israel. I have an investment property, so I can walk there if the air conditioner needs to be changed or I need to put in, another coat of paint on between tenants. So it's really, really convenient. But I want to ask you because I know some of my listeners are sitting in Israel right now. And I'm just going to throw a little bit something else in there. I was invited to a meeting. I used to work in financial planning before I started building my own business. And there was somebody from the US who came to Israel. He has a real estate investment fund where he chooses all the properties, commercial properties, distressed properties, etc. A little bit different from what you're doing. And number one, it's hard to know who to trust. That's number one. And I also went to him, and this is probably something that I will mention to you. Like there's also, as I was listening to him talk, and his friend here, and we talked about, I asked him, what about key man risk? Because he's the only, and he said, yeah, he has a huge life insurance policy on him if anything happens, because he loves to go skiing. He's also, very big risk taker. He said if anything happens, all of his investment, funds get shut down, and he has a whole process for how to distribute the assets. But in addition, if you're dealing with Israelis who are investing in the United States, we have different tax jurisdictions. And I certainly know this as a U.S. Israeli. I mean, there is a tax treaty between the countries, but I get hammered, like literally hammered on taxes because I'm paying here or there, and it seems like I just keep paying taxes.
Yes. So you answered your own question by
Okay.
describing what the guy does and who to trust.
Hmm.
Regarding the taxes, I'll put it aside, but I will talk about the taxes between two. I don't just have people from Israel, investing. We have people from Japan and France and China and other places, but the big bulk is Israeli because we have a branch there. But now is the exact time, as a response to what you asked,
Hmm.
to introduce an important, element into our conversation. And that also will answer the question that some people may ask. Hold on a second. You have kept investing for 40 years. Why are you on this podcast? Why aren't you on a yacht in the Caribbean retired? Okay, this will answer it, and will answer the question that you asked about the fund and the trust and all of that. Okay. I was blown away, completely blown away when I began a few decades ago, when I discovered something that exists in the US, which to the best of my knowledge, it may be the only country in the world. I'm not sure because there's so many countries, but in most countries it does not exist, which I consider to be the biggest financial gift in the world. And that is the key. By buying property in the US specifically,
Uh-huh.
you can absolutely change your life completely. And that gift is called the 30-year fixed rate loan.
Mm.
So to illustrate why it's a special gift, because most Americans will hear me and say, oh, I know about the loan. What's the big deal? Okay, I understand. Best to describe what happens when I speak in Europe or when I used to speak in Israel. But I speak in Europe and I tell them my Americans can get a loan called 30 years fixed. And they say, what does it mean?
Mm.
So, well, like the name implies, the principal and interest, the monthly payment, never, ever changes with inflation. It is, no surprise, fixed. It's
Right.
fixed. That's why they call it 30 years fixed.
Hmm.
And then the other thing is the amount that you owe, the loan balance,
Hmm.
even though it goes down a little bit every month as you make the monthly payment for principal, also doesn't keep up with inflation.
Right.
The Europeans treat me very harshly. They say, with all due respect, you are talking nonsense. It's not possible. I can't believe I drove 100 kilometers to hear you speak.
Hmm.
This is bullshit. This is nonsense. And I will prove to you that it is nonsense with logic. You have inflation in the US, right?
Right.
Right. You always do, right? Right. We won't get into why, but we all, yeah. Sometimes it's low, sometimes it's high, but it's always there, right?
Hmm.
40 years ago, you bought a postage stamp in the US for 4 cents.
Mm-hmm.
Today, 72 cents. 40 years ago, you went to the movies in New York City for $2. Today, 16 bucks. If you go to Whole Foods today and buy a beautiful organic avocado, $3. We know, everybody knows in 10 years, likely $6.
Okay.
In this kind of an environment where the price of everything constantly goes up with inflation because you need more dollars to buy the same goods,
Mm-hmm.
how will anybody be such a moron as to give you a loan that's going to be the only thing in the US economy never to move while everything else is going up? If that happens, inflation will become your very best friend, eroding the real value of your loan month after month, year after year, building your wealth, and you're not going to need to wait for 30 years. Typically, probably 10, 12, 14 years, your loan's going to look so tiny so as to be inconsequential, and you will have built amazing wealth. Therefore, it's too good to be true, it's not possible, and you're an idiot. Very compelling argument. Now, I ask them, can you do a little search? They search, say, oh my God, you really have this insanity in the United States. The next question is always the same. If the Americans can get this unbelievable wealth building gift,
Mm-hmm.
why don't they drop everything and run all the time and get as many of those gifts as they can? My answer is always the same. I don't know, but I sure did.
You did.
That's why I'm not retired. I have a message to the Americans especially, but many foreigners can enjoy those same loans.
Mm-hmm.
Life-changing message. And this is year 41 for me. I've changed the lives of thousands of families, mostly busy professionals. So I'll tell you one example out of thousands, and this is what it looks like. So I get a call from one of my investors, in this case, a Silicon Valley person. But don't get me wrong, I don't just work with Silicon Valley people, even though that's my background, or doctors or lawyers. I work with nurses and teachers because we buy in affordable places in the US, not in San Francisco, New York, and stuff like this.
Okay.
I'll talk about where we buy very soon. So he calls me up and says, remember me? I started investing with you guys in my early 40s. I bought just one home to start. First, because you recommend it. Second, because I wanted to see that the property manager really take care of everything, because I was busy in my Silicon Valley job, I had no time.
Mm-hmm.
So I bought one house, it rented okay, it was stable, boring even. So I bought another one. I understood what you had explained about the 30-year fixed rate loan. So I put the minimal down payments I possibly could muster to get as many of those gifts and to stretch my cash, also to buy as many homes. So I ended up buying 21 homes, he says. By the way, not so hard. At the time he was buying those homes, in his early 40s, he was buying brand new homes for $150,000 each with a low down payment. For a highly paid Silicon Valley guy, not so hard.
Right.
And then he said, last year I turned 55. I looked at my 21 homes, and they all had loans with 17 years left on them, not even halfway through the 30-year term.
Mm-hmm.
But I noticed that even though while I bought them, I put the minimal down payment, so my loans were very high relative to the home price, after 13 years, all my loans were roughly a quarter of the value of the home. So I was very ecstatic because over 21 homes, I had millions of dollars in equity. Very happy. But then I did one more thing. I took 5 of the 21 homes and I sold them. I didn't do anything fancy, no tax-deferred exchanges, just sold them and paid my taxes.
Mm-hmm.
Used the proceeds to pay off the remaining 16 small loans.
Mm-hmm.
With 16 quality, free and clear homes with no mortgage, I retired from Silicon Valley at 55. Thank you, thank you, thank you. And then he adds the one sentence that everyone says in the future, everyone, including me, I should have bought more.
Right.
It's very powerful. So the minute you buy one of these things, 2 forces start to work.
Mm-hmm.
Number one, inflation, and it never sleeps. It makes your loan smaller and smaller and smaller. Number 2, the cliche, the tenant is paying off the mortgage. Very true. And the rent keeps going up with inflation while the mortgage never changes. And if the interest rates go down, you can still refinance now. It's insane. It really is insane. So I have thousands of people in Israel. Some of them have never even been to the US. Some of them don't even speak very good English, yet they own more than 2,000 homes. And some of them have bought dozens of homes. And even from another country, from another continent, it works. I can tell you because I started working with Israelis on it after what they call the liberalization, in 98, when it became legal for people from Israel to invest in other countries. From 98 until now, they bought more than 2,000 homes.
That's amazing. So
I will be in Israel in October.
And we'll meet.
I will give a lecture and meet with investors because I love it.
Amazing. Okay, I look forward to that. I want to talk about, because there is no, return without risk. So some of the risks that I see, like someone's buying a property that they're renting out, and there's risk of vacancy. It happens, right? So you have someone, they stay there for 2 years, they leave, and it takes you a little bit of time to find a new tenant. And you might have to buy a new refrigerator, fix the electricity. There are risks that are involved. And you and I have been in the investing arena for decades. And I remember the subprime mortgage, burst that was in 2007, 2008, right? So there are incidences in the markets. Maybe, if you get in the 1980s, the 1990s, then you have the time and you can really just ride it out. Kind of
I've been buying properties for 40 years.
Right, exactly. So let's really address the risk. Like, you're in your early 70s, I'm in my early 60s, and let's say I came to you and said, Adiel, I listened to everything that you said. I happen to love the stock market, and although I do have, as I said, my investment properties, but I'm thinking of dipping my toes into the US market. So what are the risks for me at my age? And then there's people who are younger than I am who maybe can ride out different waves.
Okay, you very incredibly, in a couple of minutes, you covered about 5 key points. And you really, you covered a lot. So I'm going to try to take those one at a time, but you really said a lot. You touched on many, many things. Before I talk about the big recession of 2008 and the ones prior, which I've been a part of, let's leave that aside. I'll talk about that in a second. But by the way, before I even talk about the risks, because you are in Israel, I want to hark back to something that happened in Israel decades ago. There used to be a fixed rate mortgage for 20 years in Israel.
Mm-hmm.
And then they had 100% inflation in 1 year.
Mm-hmm.
So what happened effectively, all those fixed rate loans became 1/2 of what they really were in real values in 1 year. The next year, there was a 400% inflation. That's when they switched to the new shekel. So that 1/2 became 1/8. So in 2 years, your mortgage became 1/8. So of course, in the US, it doesn't happen so incredibly fast, but it happens all the time.
Before you go on, I will say one thing. When my husband and I bought our first home in 1991, I did the math because, yes, our mortgage was linked to inflation. And I was like, okay, let me just create a quick program in Excel because I know how to do this. And let me assume, I think at the time I assumed, I don't remember if it was 12% inflation or 16% inflation, but we were, the hyperinflation days were on their way down, but it was still double digits. And I got at the end of, I think we had a 25-year mortgage. We did not have 30-year mortgages. And I'm actually not even sure if we do have 30-year mortgages now because we've paid off our mortgage. But the last payment would have been 1 million shekels. And I'm like, it was so mind-boggling that I'm like, I guess we just have to jump in because this makes absolutely no sense.
Yes. Okay. Now that we talked about inflation, regular inflation, hyperinflation, and getting a fixed rate loan in the face of all of this, which is insane.
Right.
Let's talk about risks.
Okay.
So let's address the first thing you mentioned.
Mm-hmm.
What if the house doesn't rent
Mm-hmm.
for a month, for 2 months, for 640 months, for 7,000 months? Luckily, we were all, endowed with a mouth, teeth, and a tongue. So we can say whatever words we want. You can say, what if my house will not rent for 700 years? You can say that sentence. But the way to look at it really, and I didn't even talk about where we buy, but in a little hint, we buy in large metropolitan areas that are thriving in the United States that are also affordable. So, I mean, given that, but you live in a town in Israel, right?
Yes.
Let's say that I'm an American investor and I decided and fixated on wanting to buy an investment unit on your street. Your street.
Okay.
Now, you know your street very well,
Mm-hmm.
but I'm very nervous. I'm in the United States and I'm saying, Debbie, what if the unit is vacant for a month, for 2 months, for 6 months, for 10 months, for 2 years, for 7 years? You say, are you joking? I live on this street. It'll rent in 1 month tops. It'll rent in 2 weeks. Because you know your street.
Okay.
That's the same thing for any of those markets. If you talk to the property managers locally, they would say, come on. And indeed, we are carrying in the United States as a whole an unbelievable deficit of single-family homes because during the recession of 2008, 9, 10, 11, even 12, they didn't build for 5 years.
Mm-hmm.
The population kept growing. There is an unbelievable shortage, especially in the middle of the country, of single-family homes. The rental markets are very vigorous. Now, you add to that, you and I belong to the generation that they call, you barely, but baby boomers. You may...
No, my older brother, he's 2 years older than I am. He's a baby boomer. I'm not. I don't know what. I don't know what Gen X. Am I Gen X? I don't know what I am. Okay.
You're either barely baby boom or Gen X.
Okay.
We were instilled with buy a home, but the millennials and Gen Zs, there is a big difference in the mindset. Many of them, even though they can afford to buy a home to live in, they don't want to. They say, I want to be flexible, move around. I don't want to be weighed down by a house. And no, we are renting. It's much better. So, that's one segment of the population. Another segment is there are some people who literally, they get paid, they spend it right away. Get paid, they spend. They will never have a down payment. There are people like that. There are people who are intrinsic renters, a visiting professor, wants to be there for 2 or 3 years, doesn't necessarily want to buy. There is so much demand for rentals.
Mm-hmm.
It's staggering. So in all the markets that we are in, and I'll go into them very shortly, the rental market is very strong. I would say vacancies are less than 3%. And just like you would vigorously say, and I don't even know where you live in Israel, but I know you will say, what are you talking about? It'll rent like this. I live here. I know. Okay, same thing for her. Same thing for us. That's as far as vacancy. When tenants turn over, you may need to do some things to the house to make it rentable again.
Right.
Some of those things fall under the jurisdiction of they will be paid out of the tenant's security deposit.
Okay.
So you don't pay for them. If they exceed it, then it'll come from you.
Mm-hmm.
If the tenant did a really bad job, you can actually sue them in small claims court. You don't do it. The manager does it, and maybe recoup some money and maybe not. But usually that is part and parcel of owning real estate, as you know so well. It's perfectly fine. It's just all in the wash of the long-term hold.
Mm-hmm.
And then now let's talk about recessions. I've done it for 41 years, been in a couple of busts and booms and booms and busts, including the big one.
Mm-hmm.
So the big boom of 2004, 5, 6, even a little 7, and then the major bust of 2008, 9, 10, 11. Well, I learned some lessons, which I would like to share with our listeners here.
Yeah.
Do you know what the best strategy for an owner of a rental home is during a recession, including the major big one? It's extremely difficult. You need to do something that's extremely difficult.
Sit on your hands.
You need to do nothing.
Right. Same thing with the stock market. It's exactly the same. Your gut is going to want to make you sell and get out of there and, flee for the hills. But yeah, you just stay the course. And if you've got cash, as we both talked about, I think, Warren Buffett, cash is king. Cash is king.
But something else happens that's more unique to rental homes. So let's say you own a home in one of those markets. There's a family living in the home, and they were just about to give you notice that they are not renewing their lease because they had saved up money for a down payment to buy their own dream home. And all of a sudden, it's 2008, and the media tells them the sky has fallen, everything is exploded, recession. So there's a conversation in that home, and the conversation almost always starts with the word honey. So they go, honey, we were planning on buying a home, but there's no way we can buy a home now. There's a recession. Maybe I'll lose my job. Maybe you lose your job. No. So we are not buying a home. Okay. The kids are going to school. What are we going to do? We remain and keep renting. You, as the owner, instead of getting notice that they're leaving you to buy a new home, they remain. Multiply that by millions of times all over the country, and very counterintuitively, during recessions, the rentals are the most stable and strong because of what I just said.
Okay.
So all you need to do is nothing. It's very difficult, but you do nothing. So I will use a numerical example. One of our big markets used to be the Phoenix metropolitan area. We bought more than 3,000 homes in Phoenix over 21 years.
My sister, by the way, lives in Scottsdale, and her ex-husband was very involved in real estate. In fact, there was a time that as part of like family investments, I owned some condos, as part of the family in the Phoenix area. So I'm a little familiar with that.
Let me use numerical examples.
Okay.
Real examples. And I bought intensively. I bought a lot there. Okay, so you bought a house in the beginning of 2004, a brand new house in a good suburb of Phoenix for $150,000. And you got a loan. Back then, it was probably possible to put only 10% down with PMI. So you got a loan for $135,000. Then came the big boom of 2004, 5, 6. The house went up literally from 150 to 300. 300. So you're all exulting and ecstatic, and you have a $300,000 home with a $135,000 loan. Then came the big recession. Now your loan made some little strides down with your payment. So now it's not 135, it's 132. Okay. But the home during 2008, 9, 10 went down from 300 to, are you ready? 100.
So now you're underwater. You're underwater on your loan.
Underwater. So the media is all, if you're underwater, do this. If you're underwater. By the way, I discovered over the years who the media is because I get interviewed. The media is a 27-year-old living with a roommate in a rented apartment.
I love it.
They don't know like you. They don't know as much as you do. I can guarantee they don't know as much as I do. So the media scared everyone. So here is the person saying, my house is worth 100. My mortgage is 132. I'm underwater. I'm giving up. I'm calling the bank. Take my home in foreclosure. And that's what millions did. Now, let's see what would have happened had they sat on their hands and did nothing. Today, that same home is worth $540,000. I'm talking because I have a lot of them.
Right.
And the mortgage, that 132 by now, is 47. So you have a $540,000 home with a 47. I mean, you have $500,000 in equity in that home, which you gave up because of your knee-jerk reaction listening to the media during the big recession. So during recession, just stay put. So that's one thing. And I also talk about the safety of the notion of buying single-family homes. Not only are single-family homes the most powerful investment that exists in the US because you can leverage it 1 to 5, maybe even more. If you leverage stock, you buy on a margin, very dangerous. You can get a margin call. On real estate, you never get a margin call. And the loan is a fixed rate loan in the face of inflation. And then what did you just buy? A single family home in a beautiful suburb where families live. One of the least risky things I've ever seen in my entire life. So the combination is simply, I know I'm enthusiastic, but it's mind-blowing. It's mind-blowing.
So I love the way you talk about, like, when we take the timeline and we like extend it, we zoom out, and you're not saying that there's no risk, but it's the same way I look at the stock market because if I invest, and I wrote a book called The 1K Investor, how to, get started with basically $100 a month, $1,000, you can get started, and $1,000 in a year. And if you increase your timeline 25 years, 30, 40, 50, kind of like a 401k, because, you start when you join your company, when you're in the Silicon Valley or whatever, but you put money away. And yeah, there will be ups and downs and booms and busts and booms. But over the long term, without doing anything, your stock portfolio will increase by 10 to 11%, annual on average. There will be plus 20, minus 40, whatever, but on average.
In the case of the single-family homes with 30-year fixed-rate loans in the face of inflation, all I need is 12 to 14 years. 12 to 14 years will completely transform your life. I have a lady who lives in Israel.
Mm-hmm.
She was in the movie industry in Los Angeles. She bought only 3 homes. She is retired in Israel now. Those 3 homes, a cornerstone of her retirement. She bought only 3. Of course, she wishes she bought 7, but it doesn't matter. The 3 are making a gigantic difference every month. They're free and clear, of course. This thing is not a joke.
It's not a joke. I will say one thing because they talked about risk, and one risk that I didn't bring up, which is important for the listeners to understand, is there is currency risk because she's getting rent in dollars. And I remember 23 years ago, if I'm not mistaken, maybe 22 years ago, when the exchange rate it touched 5 shekels to the dollar for a minute and a half before it went down again. But if she was getting 4 shekels to the dollar, let's just imagine she's getting a combined $10,000 a month of rent, which is a beautiful income in Israel. Of course, she's going to have to pay taxes here, which, are going to eat up a good chunk of change. But if she was expecting 40,000 shekels, because it was 4 shekels to the dollar, and now she's getting 35,000 shekels, and her lifestyle is based on one versus the other, then, it is something people need to be aware of.
Yeah, but now you're getting into the weeds. This is in the noise because, again, it's like the old joke. You and I walk down the street and there's $100 bill and I want to pick it up and you say, don't pick it up. You're going to have to pay 35% tax on it. Leave it there. Oh, come on. Getting 35,000 shekel a month or 40 shekel a month, it's so much better than getting 0 from the, no, come on.
It is better than Bituach Leumi, I have to tell you. All my contributions, I'm not going to get much when I retire.
Okay, now let's talk about the taxes. All my Israeli investors have to be connected to a person who is both an Israeli accountant and an American accountant, or CPA, so to speak, in the same hat. And we have people like that. Mm-hmm. So whenever I work with an Israeli, let's say I start working, well, you are more expensive, but let's say I work with a new Israeli, one of the first things I do, I connect them to the Israeli accountant who knows the Israeli tax system inside and out, and is also an American account. So they prepare the tax return, they know about the treaty, the amana. Okay, so that is taken care of. And yes, the Israeli side is going to take more than the American side. Mm-hmm. But again, this isn't the noise for me. When somebody owns 10 free and clear homes in the United States, no tax system is going to thwart the fact that they're wealthy.
I hear you. I would agree with you. I'd have to really look at the numbers because that's the way my brain works. I have to see the numbers play out to make sure. And as I said, it seems like I just pay a lot of taxes. Thank God. That means that I have a good asset base. That's why I'm paying a lot of taxes. So
there's a book. There's a book that I wrote, Remote Control Retirement Riches, and it gives scenarios. What happens if you want to retire or you want to send your kids to college? What happens if you bought 2 homes, 3 homes, 7 homes? What does it look like after 10 years? So like that. So the book's available on Amazon. Remote Control Retirement. That's also the name, by the way, of the public television, the PBS show that I was invited to do. Same name, Remote Control Retirement Riches.
Nice.
Oh, and if people want to really get the gist of what it means to get a fixed rate loan, my TEDx talk that I was that I was invited to do, a couple of years ago, is only 11 and a half minutes long, and it's on YouTube. Just put my name, Adiel Gorel, TEDx, you'll find it right away. 11 and a half minutes. You may want to listen.
Amazing. We'll put the link in the show notes. So Adil, this has been really opening up for so many people who have never thought about it, about buying a home, starting their investment portfolio, or adding to their investment portfolio. What is one thing that we haven't yet talked about? It can be the joy of traveling the world when you're in your 20s. It can be, something else that you would love to sum up this episode and share with our listeners.
I would have to say, as much as it was a joy to travel in my 20s, this is too important. There is an unbelievable gift given in the United States of America to anyone from all over the world who will buy rental homes. Use the gift to change your future.
All right. I think that's a beautiful place to stop. And I really want to thank you for sharing your wisdom, sharing everything you do. And really, you really do have a message and a mission that you want to share with your people about the power of investing in single family homes. Thank you so, so much for being with us.
Thank you, Debbie. It's been a pleasure.
Thank you so much, Adiel, for sharing your amazing journey. It feels crazy that you could just leave that tech job, that you can invest in 22 properties like in 1 year. My mind is blown. And if you, my dear listener, if this has sparked something in you, I want you to take just one action. What happens is we're inspired, we learn something new, we hear something, and then it just sits with us. But what I suggest is that you head to the show notes and you grab Adiel's book, Remote Control Retirement Riches, because it is packed with much deeper information and strategies. We discussed the surface level today, but I want to make sure that you go deeper and you start learning. You start learning about investing. You can also, by the way, go to my website, debbiesasson.com/mindset, and download my Money Mindset Workbook. And that's how you're going to understand deeper what you're thinking about your money, what you're thinking about wealth, what you're thinking about building wealth, and the messages that you learned from your parents. But if you're ready to explore real estate investing seriously, I really want you to consider downloading that book, getting on Adiel's newsletter list, because he's going to be in Israel in October. Maybe it'll be October. Maybe it'll be you'll meet him in person in the United States, or you'll learn more about him. But wealth isn't about having the perfect conditions, right? You can talk about, and we talked about this on the podcast episode, right? It's not about waiting till all the perfect conditions exist in the market. There is no perfect plan. But the most important thing is that you take one step forward today with the knowledge that you have. And if you have learned something valuable from this podcast, please share it with somebody else who needs to hear it, and subscribe to the podcast. And please go to iTunes or Spotify and give us a 5-star rating so that more people can hear about building their business, building wealth, whether through the stock market, real estate, or some other way, because that's what we are here for. Thank you so much for tuning in, and I look forward to seeing you next week on the Jewish Entrepreneur Podcast. Bye-bye for now. Thanks for listening to the Jewish Entrepreneur Podcast. If you want to stop underselling and under-earning and close more sales, you need to clear the limiting money beliefs that are sabotaging your business growth. Head on over to debbiesasson.com/mindset and download my free Money Mindset Workbook. Uncover and dissolve money blocks like hundreds of other entrepreneurs who are now building 6, multi-6, and 7-figure businesses and creating true financial freedom.